Our deals review analysis for 2022 is one of the largest we've ever undertaken. Not only does it look at the UK stats and those across the south, takes into account funders and professionals in the marketplace, analyses it by the levels of activities solicitors, bankers, alt-fi and private equity have undertaken, as well as other advisors. It's really for a wide range of professional advisors, funders and business owners to consider what happened last year, what are the factors they need to take into account for their own position going forward so they can maximise the chance of achieving their aspirations. This graph shows the deal volumes throughout the year, look at it from a South point of view and the UK perspective, and you can see from the trend there the peak in the early part of the year, but significant consistency with the prior year throughout the rest of it. 2022 had significant challenges and uncertainties for many people, and it's therefore perhaps surprising that deal volumes continue throughout the year at a very similar level to 2021, which in itself was a record year. In terms of other trends, by sector there was significant divergence, with some sadly suffering significantly as the effect of increasing interest rates and inflation had an impact on their own activities. Whereas in other sectors, whether it's healthcare and tech, they had significant opportunities for growth and there was a massive amount of private equity money directed in that way. Other themes were in the types of transactions undertaken, with a lot of buy and builds, where one corporate, instead of just buying one business and that's it for a number of years, they would undertake multiple acquisitions in the same year or over a short period of time. In a number of cases, those businesses are supported by private equity, as seeing it as a great way of driving value up in a short space of time. The topic of valuation of multiples is really quite an interesting one when we look back, because the expectation with the uncertainty in the market is they'd actually be declining last year. But as we were alluding to earlier on, with a lot of money around, looking for a home, prepared to take higher risk or needing to take higher risk to get a return, it actually drove up and maintained a lot of the multiples and valuations that businesses could achieve. Some sectors though were suffering, and therefore it doesn't apply right away across the board, and those that were, maybe deals weren't actually happening, and therefore the decline in multiples wasn't actually so visible because deals weren't happening rather than actually being just at lower amounts and pricing. We then had the UK putting a 20% off summer sale in view of the change of exchange rates, which meant overseas buyers could suddenly become far more effective and competitive, competing for UK assets compared to UK-based businesses. This helped maintain or even drive up pricing even higher, despite the fact there may have been more uncertainty from a pure UK market. In 2023, I think the sectors that will be most active will be the likes of tech, healthcare, especially the combination of health tech, along with energy. Others, such as financial professional services, will have a continuing level of activity rather than any significant changes. Areas that may come back from a different perspective for the likes of property and construction, but for the other end of the spectrum, not because everybody's after them for the future opportunities and how well they're doing, but because a number of those will actually need significant refinancing and restructuring because of the issues they would have faced. Businesses that have recurring revenues are, by their very nature, more attractive to funders because there's more certainty of their future income streams, and therefore it's perceived that the risk is lower. So in any sector, those that can get recurring revenues are actually going to be in more demand rather than necessarily it just being purely down to what sector people are applying those to.